Okay, let's continue our discussion on the causes of the Great Depression. Let's make sure we're clear on what events and what choices that were made by the federal government and the Federal Reserve as well that are going to make this thing even worse. Now, on the consumer side, we're talking about borrowing money to survive. So when things were getting tight, and actually in the Roaring '20s, because the economy was strong, people were becoming more able to borrow money on credit. And the credit system was used to buy some of these new technologies that become popular. For example, the automobile. Henry Ford is now making the Model T, and he was making hundreds and hundreds of them a day, producing actually I think up to 2,000 a day. So he could drop the price. You could get a Model T for less than $500. People could afford a car now. Also, you can see in the middle, you had a refrigerator instead of an ice box, which is something that wealthy people had, where you actually literally cut a block of ice, stuck it in the top of this wood box refrigerating looking thing, and it kept the food cold as long as the ice was in there. And you had to keep replacing the ice, which was very expensive. But now, middle class or the average person might be able to afford this new technology called the refrigerator, so you don't have to go to the grocery store, you have to purchase food daily. So all these new technologies are making life convenient. People are going to want to borrow money. They might not want to pay for that, or they can't afford to pay it right then and there. But if somebody's willing to give them some money, they could pay them back, maybe within payments. So the first thing we're talking about is many Americans use what's called installment payment plans. They're borrowing on credit, similar to a credit card, but not exactly, where people made a small down payment on an expensive item such as cars, refrigerators, and etc., and made monthly payments. Okay, so it's kind of like credit, but it was called an installment plan. We still have installment plans sometimes today, like at Rent-A-Center or rent-to-own places, where you put a small amount of money down. Say you want to buy a nice couch and sofa, it's $1,500. So you have to put 10% down. So you have to put $150 right then and there, and then you get to take this sofa even though you can't afford it right then and there. And then you have 3 to 5 years to pay it back. And the way they do is they charge you interest. So every month you're paying maybe 10, 20% interest. So actually within the 3 to 5 years it takes you to pay back the sofa, you've paid for the sofa not $1,500 back. You've made them maybe $4,500. You paid 3 times as much. This is actually kind of similar to how we purchase homes through banks. So we buy a house, you don't have the money. Most people don't have enough money to actually pay for, say, the average house in Missouri is $120,000, I think. So if you have a $120,000 home, most people do not have $120,000 cash to go buy a house. But they go to the bank, and on credit, they might put 5% down, which is only, $6,000 or $7,000, and then they make a payment every month. And the bank does this because in 30 years, you're going to pay for the house on average. The average house is paid back 3 times. So if you buy a $120,000 home and you pay on time at the minimum balance, the lowest amount, for 30 years, which they want you to do, they're going to make $360,000. They make $250,000 interest just off you not paying it off or paying for it right then and there. So this system can work, and it does work. It only doesn't work back then, and still today we've had problems, is when people are spending money they really do not have. Okay? So the amount of debt and interest that's paid forced people to buy less things and decrease demand. Okay. So what happened is people couldn't pay back all this debt, or they might spending all this money just on one item, like a refrigerator. Well, if that's all you can afford is a refrigerator, then you're not going to buy a car. You're not going to buy other items, and the less purchases, the less demand, the supply has to go down. So if you're making less stuff, people get laid off. So less people are farming because people can't afford as much food. Less people are working at the Ford factory because less people can afford Ford cars. And the economy starts going down, 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 and tail spinning out of control. A good example of how this connects with the Great Recession of 2009. Well, in 2009, it wasn't really caused too much by the stock market initially. It was more caused by credit on small items like refrigerators or cars. 2009, it was really based on credit for houses. And, I can tell you from personal experience that the bank had told me you could buy a more expensive house. And understanding some economics, I said, no, I really can't. I think that's too much money. that I'd be living outside of my means. They said, "Oh, no, Mr. Metropoulos, you could spend at least another $30,000 and get a nicer house." I said, "No," because the rule of thumb is with housing is, guys, you don't want to spend more than about a third of your income on your house payment. So, for example, if you make $1,000 a month, your house shouldn't really cost more than about $330 a month, because the other money is going to be used for utilities, food, and everything else. Now, what was happening in 2009 is the banks were telling people, "No, you're good," and people are trusting the banks, and they were purchasing houses way outside of their liens. So people still today have houses where they're paying 50% of the money they make. They have to pay just to pay on their house mortgage, which is a lot of money. Now, if you're smart and you're paying attention today, we've talked about this, you can use this credit to your advantage. Meaning, if you get a credit card and you buy things and you pay it off, and you always pay on time and you build your credit up, then it is going to make your life a lot easier. You can actually have interest rates low, so you can purchase a house at a very low interest rate. If you're not responsible, you're going to get paid for it in the end, because then it's going to be very hard to buy a car. That's why maybe you'll go out and you'll see people that are responsible, or a lot of times people that are older, they have really good credit. They're going to be driving a brand new Cadillac. Meanwhile, you see somebody my age, and they weren't responsible, and they're paying as much for, that person is paying for a Cadillac because they have to pay so much interest. They're paying $500 a month on a car just because they have to pay 20% interest, because they don't have good credit. So there's a lot of benefits that making sure you're responsible for your credit. You can get your houses cheaper, cars, big items. Okay, so we're going to talk about the next step, the Federal Reserve. Now, the Federal Reserve is a very important institution. One of the mistakes Americans make is they blame everything or give all the credit to the president when it comes to the economy. They say Barack Obama is destroying the economy. Barack Obama is making the economy great. Barack Obama saved the economy. The truth is, the Federal Reserve has the real power over the economy. Not to say that the president and the legislative branch, they can do what's called fiscal policy, and fiscal policy is spending money, the government spending money, but that's not going to have as big of an impact, usually speaking, in terms of what's called monetary policy. Monetary is the choices the Federal Reserve makes. And this guy in the middle is Ben Bernanke. He's actually just being taken over by a girl named Janet Yellen. She's the new head of the Federal Reserve, and he's been the head of the Federal Reserve for several years now, but he's stepping down. And these guys, like Janet Yellen, is going to be so powerful, guys, that it's virtually impossible for the president to fire them. So they're not like a third. They're kind of, some people say they're kind of like the fourth branch of government, except there's not too many checks and balances on these guys. While the president chooses to keep them in place or hire them, once they're in there, usually presidents won't touch them, because it's very dangerous to mess with these guys. The head of the Federal Reserve is a economist, usually from a university. I believe Bernanke is at a Yale University. They're professionals that are really dedicated to controlling the money supply in America. Now, you can see that building on the bottom right-hand corner. That's actually the Federal Reserve in St. Louis. And St. Louis is one of the 13 cities in the United States that actually has a Federal Reserve. Interestingly enough, Missouri has a Federal Reserve in Kansas City and St. Louis, and we're the only state in America that has two Federal Reserves. There's only 13 in the whole country, and not too many west of us, because the country didn't have too many people out west of St. Louis up until 50 years ago. And you can see in the bottom left-hand corner, there's the Federal Reserve in Washington, D.C., and that's the big bank where all the presidents of the Federal Reserve, including the head of the Federal Reserve in St. Louis, they go to meet once every 3 months and decide what to do with the economy. So the Federal Reserve is considered like the central bank or the American bank, which is really important. They actually make money, believe it or not. They're run so well that they make money. Now, during the Great Depression, we're going to find out that the Federal Reserve was not run so well, and they didn't have much experience either. They'd only been around since 1913. So you're talking about less than 30 years they'd really been around. So let's see what they did. They did everything wrong, which we've learned from, and the Federal Reserve actually did not do these things in 2009 during the Great Recession and helped us get out of that. And fortunately, the recession did not turn into a depression. Okay. And remember, recession means that the economy recedes. To recede is to get smaller. Like, I wish my waistline would recede. I'd lose some weight. Um, but a depression is actually, it's almost like the economy is being held down, and we don't know if it can come back. The chances of us going into a depression is pretty low because we do understand a lot of the things we did wrong during the Great Depression, but it is possible. So recessions still happen, but depressions have not happened since the Great Depression. So let's look at what's going on. So the Federal Reserve makes mistakes pretty clearly. Here, I love this picture to the left. It's perfect. It says world's highest standard of living. There's no way. There's no way like the American way. And then you can see all these guys are in line. You want to take a guess why they're in line? They're in what's called a bread line. They're waiting for food and soup, and they literally give you a bowl of soup and a piece of bread. So the first mistake the Federal Reserve did was this, and this actually led to, as one of the causes of Great Depressions. When the economy was good in the 1920s, we call the Roaring Twenties, they kept the interest rates low. That's a bad idea. This helped banks make risky loans. Companies throughout the economy thought the economy was growing. Companies borrowed money and supported overproduction. So by them keeping interest rates low, like for example, Ford Motor Company might build a new factory in St. Louis, in Hazelwood, which we used to have a factory, because they thought, okay, well, the government's letting us borrow money really, really cheaply. Our banks are letting us borrow money really cheaply. So let's keep building. And lots of people, the economy's doing great. People can afford cars. And the truth is the economy is slowing down. This is where it gets confusing. You, me, and any customers, we can't just go borrow money from the Federal Reserve, okay? And people think that the Federal Reserve could just make a bunch of money. Why didn't you just make a bunch of money? I had students ask me that. Mr. Metropoulos, why didn't the American government just have the Federal Reserve make a bunch of money? Things are bad, make more money so people can buy stuff. Doesn't work like that. You'd like it to work like that, but it doesn't. The biggest example of a horror story with that is Germany. In Germany, before World War II, during the Weimar Republic, the Germans did exactly that. They published or produced tons of money and gave it out. Essentially what happened is the money became so worthless that people were literally burning money to keep warm. There's reports of people using it as toilet paper because it was cheaper to use money than to actually go buy a roll of toilet paper. And it got silly. A loaf of bread was 50,000 marks, which is like 50,000 American dollars. And it was just nonsense. The money became worthless because if you understand the law of supply and demand, the more money there is, the less demand there is. There's a large supply of money, less demand there is. So these guys have to be really good at making sure that the supply and demand of money does not get out of control. Now, if it does, when it gets too valuable, we call that deflation. The money becomes worthless. When it becomes not valuable at all, it has no value at all, we call that inflation. And it inflates, like the balloon lets the air out, and it's worthless. Okay? So the first mistake they did is this. They create the interest rate where banks borrow money from originally. Okay? So the lowest amount of, if you want to go to somebody to borrow money, the lowest place to go would be the Federal Reserve. Very, very important. However, we don't borrow money from the Federal Reserve. Only banks can, and only certain banks can. So banks borrow from each other, and then some borrow from the Federal Reserve. So when things are good, they kept the interest rate low. So banks borrowed tons of money, and they lent a bunch of money out, and people made bad loans. They would waste money, or they would give people money that couldn't afford a loan, and they bought cars and houses when they couldn't really afford it. And businesses built new Ford plants and all these factories, and nobody actually could afford this stuff. So they did exactly what you're not supposed to do. So when times are good, the Federal Reserve should actually be slowly increasing the interest rates to get the money out. Because if there's too much money out there, it's going to cause inflation. So they want to just take out a little bit, but they don't want to deflate, make the money too valuable. Then during the Depression, they did the complete opposite. In the Great Depression, during the Depression, the Federal Reserve increased the interest rates. And this had horrible consequences. The companies then had to lay off workers because they could not borrow money. Okay? So now when things are bad, what should the Federal Reserve do? They should decrease the interest rates on the money that they're lending to banks. They want loans to get out there. They want money to flow in the economy. That's called liquidity. Liquidity is the idea that money needs to flow throughout the market. Now, when things are bad, you want liquidity. You want lots of money out there. You want people spending, buying. You want to jumpstart the economy. You want to get people to start buying and building factories and hiring people and starting businesses. But what they did is they made the interest rates high. So now it's 10 or 15% to borrow money. So the banks didn't borrow any money. And when the banks aren't borrowing money and things are bad, things get worse. Now people that even had money to start a business can't do it. So the whole system just starts collapsing. So the Federal Reserve, again, when things were good, you're supposed to keep the interest rates higher so that the money's not out there. But when things are bad, you're supposed to keep the interest rates low so people borrow money. We have liquidity. Okay, and the final idea we're talking about on this video is the Smoot-Hawley Tariff Act. The Smoot-Hawley Tariff Act. Now, this is the federal government and what's doing fiscal policy. So that was monetary policy as the Federal Reserve. This is fiscal policy. The Smoot-Hawley Tariff Act was exactly that. It was Senator Smoot and Hawley, I think of Oregon and Utah, they came up with a great idea, or what they thought was a great idea. They thought that the way that they could help America was creating a tariff. Now, tariffs are a tax on imported or things coming into our country to be sold. So they thought that if they put tariffs, they raise taxes on the stuff that's coming into the United States, it would make the things that are built in the United States or made in the United States more competitive. It actually hurt everybody because now there was no competition with the stuff that was made in America, and who really gets hurt with tariffs usually is the consumers. So most people don't actually build cars. So while it helps the Ford car company, it hurts the American consumer because we can't buy. We have to buy cars at whatever price Ford will charge. And also, if we buy a Toyota, which is a Japanese car, we have to pay all this extra tariffs. We do have tariffs on cars today. We have tariffs on most things still today. But if the tariff gets too high, it gets out of control. So they put a tariff on over 20,000 imported goods. So how do you make the Great Depression worse? You keep kicking these people while they're down. Now I can't borrow money from the bank because the banks can't borrow money from the Federal Reserve. Now I can't afford anything because there's huge taxes on it. And they thought this is a great idea, but it isn't. Only a couple American businesses are really going to take off, make some money off this. But everybody is hurting because they can't afford it. Just simple things in your life. So now you can't borrow money. You can't buy anything. And everybody's losing their jobs because nobody's being purchased. And you could see how this is just tail spinning. It's all going out of control. And we'll meet back for the next video.